let's talk about something that trips up so many people when they file their taxes. You think you're getting a much-needed credit, but what you might actually be doing is walking straight into a trap. Today, we are diving deep into Form 2441 and what we call the Spousal Care Trap. So the big question is, can you claim a tax credit for caring for your spouse? And the answer is, yeah, technically. But here's the problem. The yes your tax software gives you and the yes the IRS requires are on two completely different planets. And that gap, that's where things get really dangerous for a lot of good, well-meaning people.
This right here, this slide shows you the whole problem in a nutshell. We call it the split reality. On one side, you've got your friendly tax software. It asks a simple little question. Is your spouse disabled? You click yes, and you move on, feeling good. But on the other side, the IRS is waiting, and they're demanding a literal fortress of evidence, what we call forensic proof. They want every detail, proving not just the disability, but that the care was absolutely essential for you to be able to go to work.
So here's our game plan for today. We're going to break down the spousal care trap itself, then tackle the incapacity illusion. We'll show you how to build a forensic-level defense file, decode the financials, and go over the audit triggers and their consequences. Finally, we'll show you how to become the architect of your own financial defense.
All right, let's dive into Section 1, the Spousal Care Trap. This is all about understanding that huge, dangerous gap between what the rule says on paper and what an IRS auditor expects in real life.
Everything, and I mean everything, hinges on this one single phrase: physically or mentally incapable of self-care. And you have to understand, the IRS definition is incredibly strict. This isn't just about someone having a hard time. We're talking about a documented inability to handle basic hygiene or nutrition, or needing someone there full time just to keep them safe.
And to get even more granular, the IRS measures us using something called activities of daily living, or ADLs for short. Can the person dress themselves, bathe themselves? Can they get from the bed to a chair without help? You see, an auditor isn't just looking for a doctor's diagnosis. They are looking for hard proof that your spouse fails in these very specific, fundamental areas of life.
And this, my friends, is the trap. So many taxpayers think, oh, I'll just get a note from our doctor, that'll be fine. I'm telling you, it is not fine. It is not even close. When you're under audit, the IRS is looking for what we call an asset defender level of proof. That's a file so thorough, so comprehensive, that it leaves absolutely zero room for an agent to question it.
So, if a doctor's note is basically useless, how in the world do you build one of these asset defender files? Well, that brings us right to Section 2, your forensic defense file. Think of this as the invisible mechanics, all the stuff happening behind the scenes that makes your claims solid.
A truly bulletproof claim really stands on three pillars. First, you've got to go way beyond a simple note. You need detailed medical records, the doctor's prognosis, and formal assessments of those activities of daily living. Second, you absolutely must keep daily care logs. This is how you prove the expense was work-related, that you paid for this care so that you could work. And third, you need formal, written care agreements. This is huge, especially if you're paying a relative. It proves this is a real job, not just you giving them a gift. And speaking of who you pay, be really careful. You can't claim this credit for payments to your own dependent. Oh, and if the caregiver works in your home, watch out. The IRS might decide they're a household employee, and suddenly you're on the hook for employment taxes and a whole other form, Schedule H.
So why all this work? Why does it have to be so intense? Because the IRS makes it painfully clear. The burden of proof is 100% on you, the taxpayer. It's not their job to believe you, it's your job to prove it to them beyond any shadow of a doubt.
Okay, let's talk money. Time for Section 3, decoding the financials. Because even if your documentation is absolutely perfect, you still got to get the numbers right. And trust me, there are some pretty unique rules here. Now, one of the most important and frankly weirdest rules is called the deemed income rule. See, normally both spouses have to have earned income to get this credit, but the tax code creates this legal fiction. If your spouse is incapable of self-care, even if they have $0 of actual income, the law deems them to have earned $250 a month. It's a workaround, and it's what makes it possible for the working spouse to actually qualify. Now, there is some good news on the horizon. Starting in 2026, thanks to the One Big Beautiful Bill Act, the maximum credit rate is jumping all the way up to 50% of your eligible expenses. That's a big deal, and it makes getting this claim right even more valuable. But, and you knew there was going to be a but, right? Here's the catch. While that percentage rate is going way up, the actual cap on your eligible expenses is not changing. It's staying right at $3,000 for one qualifying person and $6,000 for two or more. So while it's a better credit, there's still a ceiling on how much you can get. All of this leads us right into the scary part. Section 4, Audit Triggers and Consequences. Because when the potential reward gets higher, you can bet the IRS scrutiny gets a whole lot tougher. Get ready for this number because it is absolutely staggering. It's estimated that 90%, 90, of filers who claim this are at risk of failing an audit. Why? Because their software made it seem too easy, giving them a false sense of security. And they just don't have the deep forensic level evidence that we've been talking about. So what happens if you get that dreaded letter and the claim is disallowed? It is a financial nightmare. You face what's called a liquidity crisis. It's a triple whammy. First, you have to repay every single penny of the credit. Second, they slap you with a 20% penalty. And third, you have to pay all the interest that's been building up. For a family already struggling with care costs, this can be absolutely devastating.
Okay, enough doom and gloom. Let's talk about solutions. Let's turn this whole thing around. Section 5 is all about how you can become the financial architect and build a strategic defense protocol for your family's finances.
Here it is. This is your playbook, your mandatory checklist. You need to be verifying the incapacity with a physician every single year. You need to maintain those daily care logs contemporaneously. That's just a fancy word for doing it in real time, not trying to remember what happened 2 years ago during an audit. Review your care agreements annually, and this is a big one. Make sure your caregiver is actually reporting the income you pay them. Then take all of this proof and store it in what we call a legacy vault, a safe place, both digital and physical, that's ready to go at a moment's notice.
It's all about shifting your mindset and adopting this architect approach. You stop being a passive taxpayer just filling out a form, and you become a proactive planner. You're using documentation not just for taxes, but as a defense, and you're thinking strategically about protecting your family's assets from the high cost of care and potential IRS assessments. So I'll leave you with this question to think about. Is your tax return just a form you fill out every spring? Or is it a key part of your family's financial defense plan? Because when it comes to the Spousal Care Trap, the difference between those two ways of thinking, well, that could change everything.